Hello and welcome to this week's Market Outlook webinar. If you're watching the recorded version of this, it was held live on Wednesday, September the 6th at 12:30 in the afternoon. So this is a webinar that happens every week, and in the background, I think that's the restaurant next door emptying their drink bottles, if you can hear that. But we do this every Wednesday lunchtime at 12:30, and it's there are two aspects to this. There's a look at the markets, so a look at maybe some levels to look out for and some trends in the days ahead, but also a little bit of a strategy session as well. And I think today we're going to do a bit on setting stop losses. You know, why do some people find it so difficult? Is there an ideal way of doing it? And we'll look at the theory and the practice, I think, of doing that. But while I'm babbling away, let me just bring up the risk warning so you can see that there. It does feel that markets are getting a bit back to normal again after the summer. I think we've had some scrappy trading in the last couple of weeks, but I think maybe what's happening in US stock markets is potentially the interesting thing for the next couple of days. So we'll kick things off by looking at that. So let me just flip over. So we'll flip over to, this is TradeHub. This is Aondo's trading platform. So I thought what we'd start with, this is a daily chart of the S&P 500. So it's the broader US stock market going back to the Trump election, sort of October, November last year. And you can see, you know, we all know about the massive volatility we had on after the presidential election when those results were coming out. So I thought maybe the trend line to pick up on is after maybe some of that volatility had calmed down and we saw the market having something of a smoother move. So we've had this trend, you know, off that first reaction low following the presidential election. So from mid-November to mid-August. So we were, what, 9 months into this trend, or 8 months into this trend, whatever it is. And the market, you know, was making all-time highs, as we know. Any sell-offs would see the buyers come out, blah, 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 blah. You know, we've seen really strong moves in stock markets, not just the US, but just the US we're focused on here. I think maybe what's interesting is maybe the moves over the last couple of weeks. I mean, within an element of this, I think, you know, clearly there's the summer lull, you know, volumes maybe aren't what they could be. We have all this North Korea political tension swirling around, but I thought it's maybe worthy of note that it has, you know, slipped below that trend line for the first time since the trend line started in November. And I'm just wondering, you know, thinking that the bounce back that we've seen, we had, you know, clearly fresh all-time highs for the S&P 500 just in August. The bounce back we've seen, you know, we haven't yet seen those highs taken out, and again some volatility again yesterday. So I think US markets are interesting, you know, as usual. I mean, it's a braver man than me who calls the top for the US stock market, but I think given the moves we've seen maybe over the last 2 to 3 weeks, there's maybe the very first sign of nerves coming in amongst investors. I mean, clearly the threat of World War III is enough to make any investor nervous, but I think that's had an impact. And I thought what was interesting yesterday with the S&P, and again this would be the same with the Dow as well, on Sunday night, again I think because of that testing of the latest missile, wasn't it, I think over the weekend. So we saw on Sunday night in Asia the markets, let me make this maybe a short-term chart, stock markets gap lower in out-of-hours trading. Here we go. So we're not, there we go, that's it. So we're not actually seeing the gap there, but that was a gap. It closed there on Friday and opened down here on Sunday. And then Monday, the US was shut for Labor Day. And when it started trading properly yesterday, we did see initially those out-of-hours lows hold, but I thought it was interesting that it really sold off. You know, sold off really hard. And it does seem to be the theme for the moment of the market. You know, when it goes down really quickly. And so far, we do seem to see a willingness for the buyers to step in and you know, see it as maybe a bit of bargain hunting. But I do wonder if this latest batch of weakness is over, and maybe this is a market, we'll see what happens this afternoon, but a market that might still, you know, struggle to maybe regain the levels from next week. So I think it's maybe a welcome return of volatility in US stock markets, and going back to that bigger picture, you know, are we seeing the first signs of weakness? I think for me, you know, if it breaks out to all-time highs, I think 2490 is the all-time high so far just from last month on the S&P. If that level gets broken again, then forget about it. You know, off we go. You know, we're off to the races once again. But I think it'd be interesting to see if what's happened over the last couple of weeks has really made investors a lot more cautious than they have been for some time. So that's US stock markets, I think, an interesting one to keep an eye on. Let's take a look at maybe some other markets that have been linked to the nerves we've seen over this North Korea. I mean, the obvious one is the price of gold, and I missed getting on this. I'm sort of kicking myself, you know, because all this year I've been thinking that yeah, it would be a year for gold to recover, but I'm surprised by I think the strength of the move we've seen since early July. You know, so in what, 2 months, the price of gold is up $120, so a 10% rise in the price of gold. So where it's currently trading, so just yesterday was the highest level since, I need to flick that out to, highest level since about a year, isn't it, on gold? Let's take a look. So this is a weekly candlestick now, so 1337, yeah, best levels since September last year when it ran out of steam. So for me, I think the obvious bigger picture target for gold is a run back up to those 2016 highs, so around about 1375. I think that would be the next target, and I think if it can break, and I think it will, maybe not in the next month, but I do think we'll see those old highs broken, because we've got, you know, the market, for me, that downtrend the market had been in for the last few years, a minor downtrend within the bigger picture, you know, does look to be down, over. The break last year was the confirmation of that. The market gives a bit back, doesn't take out the old lows. So this for me is maybe another leg higher. But I think the immediate obstacle would be the sort of 1375, 1380 area. But it's still bullish. You know, it's a market that, again, clearly fueled by what's going on with North Korea and the US. You know, it's a classic safe haven destination in times of trouble. Plus, it's been a really weak year for the US dollar. I was just reading over the weekend, I think every month since February, the US dollar index has lost ground. So we've seen continued dollar weakness all this year. And of course, if we see dollar weakness, then the price of gold goes up. So there's a bit of a double whammy for gold. Weaker dollar and political tensions have all helped to lift it. So what would we do with it right now? You know, where it's trading now? If we plonk a bit of a trend line on the price, it looks something like that. So, you know, if we're looking at this trend from last July, well, this July just gone 2 months ago, the trend's clearly up. You know, so any weakness, we'd want to be a buyer. Clearly, I think if we did get a dip below $1,300, it looks like a buying opportunity, and that's only where it was not even a couple of weeks ago. You know, with I think, you know, sort of big support coming in this sort of area, but it's a market where you know, it's still strong. We see the dips do tend to bring the buyers back out. Here's a shorter term chart. This is the hourly chart. So again, I think if you were an aggressive trader, you might want to put a stop under yesterday's low. That would be a bit too aggressive for me. Maybe a better one is just out here below 13.15, the level it was sort of faffing about with before the latest breakout through those highs from the end of August. But you know, the trend for gold still most definitely up. So I think on the subject of sort of where to place stop losses and where we'd want to get into a trade, let's just take a bit of a break and talk about this, the idea of where we might want to place stops. So what I'm going to do, I'm going to bring up my scribbly bit of paper and see how this works. Let's see if I can scribble this around screen 2. Right, let's see how this works. No, this doesn't work. Why is that not working? Every week I have this problem. Here we go. I think I do my bit as usual for BMW's marketing. There we go. So I think a common problem with stop losses is a common complaint that I've heard over the years is, oh, if I place a stop loss, then first of all, the broker or the mysterious market will know where the stop loss is and will go looking for it. I have to say this is complete cobblers, in my opinion. You know, if you, unless you're maybe, you know, JP Morgan or Goldman Sachs, I don't think you need to worry about the market going looking for your stop losses. I think it's just an excuse that people use to avoid having to admit that they might be wrong. Why does that keep disappearing? So I think that's a poor excuse. The other excuse that people make is, well, if I place, no, it's not an excuse, but their experience of using stop losses is a negative one because they keep on getting stopped out. They might buy into a market, put a stop loss, get stopped out, and then the market goes off to the races without them. But that, I think that's a function of poorly placing stop losses rather than stop losses are a bad thing. So let me just try and scribble and explain this. So if we have a market, let's say that gold chart, in a simplistic way, gold over the last few years has looked like that. And last year, it looked like that. It broke out and it's pulled back, and this year it's sort of like that. So I think the mistake people make is placing stop losses too tight. And I can remember so many conversations about this over the years where I was banging my head against a brick wall. But I've had conversations with people who had a trading strategy, for example, for trading euro dollar that they haven't actually traded yet, and they were going to trade it with a I can remember one, a 2.5 point stop loss. Now, I know the spread on euro dollar is tight. It's less than a 1 point spread, but what are the chances that you nail the next move in euro dollar to 2.5 points of accuracy? It's just completely ridiculous. So the idea is, we want to set stop losses that give the market time to prove us right. And I think the problem is, let's pretend this is gold, and let's say the market is currently trading at 1340. So we might think, okay, well, I think the market's going to go up from 1340. I'm going to do a spread bet or a CFD, whatever, and I'm going to do £10 a point. So every $1 move in the price of gold is worth 10 quid to me. I think, well, I only want to lose 50 quid on this, so I'm going to place my stop loss at 13.35. So 5 points away from where I'm getting in on the trade, and that's fine. But if this level down here, for example, is 13.20, that's a much more logical level to place your stop loss. And if you're placing, the temptation is, and I do see so much rubbish written on this, I think, about trading with tight stop losses. I'm not saying that nobody can do it, but I'm saying that most of us can't do it. I think if we're not giving the market time to prove us right, we are in effect just, when we're placing a trade, we're just cutting up tenors, in this example, because you're not giving, then who said the market can easily do that, wiggle around, and then bang, off it goes. So I think, the most important thing for me when placing a trade is placing the stop loss in an area where if the market goes there, then my view has been proved wrong. So a better stop loss would be here. Let's say that level is 1300, for example. A better stop loss would be below that low. If you think the market is really going to take off, then you need to give it a lot of room just in case it decides to revisit that low, that old low. And if it does break through that low, then your view is wrong. So I think it's really important to understand that it's not about how much you want to lose, because the market doesn't care how much you want to lose. It's setting your stop loss in a place where if the market goes there, then you're wrong. And there are some good examples of this at the moment. Let's flip over, because it's all well and good in theory, of course, but let's have a look at I think dollar yen's a good example at the moment. Let's just talk about this stop loss idea for now. Dollar yen and the DAX, the German 30. So dollar yen. Let's take a look at a daily chart of the dollar against the Japanese yen. So it's an interesting market. I don't think we've looked at this for a while, but we do get some great trends when it starts moving. So we've seen for much of the first half of 2016, the story was dollar weakness. So the dollar went from 121 down to about 199 on dollar yen. So we saw a big slide. Then we saw a big recovery in the US dollar at the end of last quarter of last year. And then this year, it's all been a little bit sideways and drifty. But I think what is interesting, so if you were a dollar bull, and given everybody is bearish on the dollar, it feels like everyone's bearish on the dollar at the moment. Maybe this is a time when the dollar makes something of a comeback. Anyway, let's say you were bullish on the dollar. You've got a really big level, and if you've attended these webinars before, you'll know what a big fan I am of the big level. Got these old lows at 108 on dollar yen from April this year. Let's just click that in and zoom. So whenever we've seen dollar yen, then that was the first real signal off that level, once the level had been established. Whenever we've seen dollar yen, it'll sell off towards 108, the buyers come back in, lift the dollar up. We saw it again, when's that? 29th of August, so is that just over a week ago? And we're seeing it again happening today. Okay, so I think, so this for me is the perfect example of, well, if I was buying dollar yen here, because I thought it was going to go higher at 109.92 or 110, let's say, if I'm buying there at 110, then if I'm if I don't want to lose much money, I might put my stop at 109.50. But it's completely meaningless, as has been proved by the dollar yen sliding back to those old lows. But if you had a bullish view on dollar yen, not that I'm saying this is a trade to do, but this is if you were bullish on dollar yen, this is the place to buy it, because we're a buyer at 108.85. We've got an obvious level there, 108. If dollar yen falls below 108, clearly there's been a shift in sentiment, because this level has held the market up for the last, what's that, 5 months nearly. So it's really interesting. I think that's a really interesting one to watch. I must admit that is a trade I'm tempted to do on dollar yen, because it does look like the famous last word, such the perfect setup, doesn't it, where we've come down to the level a couple of times now and it's held. And maybe another strategy is, if we're a buyer here, wherever it is, 87 now, if we're a buyer here, we'll have a stop and reverse. If we buy, let's say, I don't know, £5 a point here, we have a stop if the market breaks that level, and then to go short, because I think it will be, again, famous last words, I think if we saw that 108 level breached, because everybody knows it's a big level, you'd expect something of a reaction off that. So I think it's really interesting down here, dollar yen, but it's more because of this point about stop losses. Where do you want to set your stop losses? You want to set them obvious levels. We've seen just over, well, today, isn't it? Is it September the 6th today? Yes, the 6th of September today. We've seen since 1 o'clock this morning, the market has started to turn, and you can see just how quickly in the past we have reversed off this area. So it's an interesting one at that level. Isn't it another one on the German 30, on the DAX? The DAX, funny old market the last few months, because even though just 2 or 3 weeks ago the S&P 500 made fresh all-time highs, the DAX has been losing ground since since the end of June now. But I think you could say it's not as good a setup as the one we had for dollar yen. But this whole sort of 11,830 area, it was highs on the way up in January. The market sold off, broke out, came back down to it, held a bit here before pushing higher, and we saw just back on the 29th of August that the DAX pushed down towards 11,800 and bounced back up. So again, for me, if I thought, well, the weakness in the DAX is overdone, and I think this is why people struggle with stop losses, putting them in the right sort of area. If I'm a buyer here at 12,141, and I think that the DAX is going all the way back to 13,000 or something, so I've got 900 points upside, the logical place for my stop loss is the other side of this level. That's because by definition, if I think the market's going up, then it shouldn't go down too much. It sounds obvious, but that's clearly, I think, the trade here. So my stop would need to be something like 300 points away, unless I want to have tight stops and keep trying to buy it and buy it and buy it. But that, for that trade, and people struggle with that. I think people struggle with giving markets enough room to prove them right. But the DAX, even on a quiet day, and yesterday looks like a quiet day, traded through a 200-point range yesterday. Actually, not quite 200 points, 160, 170 points, but 12,214 was the high, 12,040 was the low. So you need to give markets time to move around, and I think it's one of these things that most people don't want to hear that, because most people want to think, I can trade euro dollar with 10-point stops, make 30 ticks a day, be buying Lamborghinis at the weekend. That's not, that's not the reality. It might be the reality for a small percentage of people, but in reality, for most of us, it's not going to be the case. So I suggest, giving the market a bit of time to move around, looking for obvious levels for placing stop losses is the way to do it. Right, let's get back to the markets. What are we talking about? Euro dollar. Euro dollar has hit a 2.5-year high. It's gone a bit quiet over, I think, the last couple of days or so, but once again, the trend in euro dollar, let me do my usual thing and check with another broker who publishes sentiment data, because I can guarantee you it's much easier than trading, trying to predict which way people will be positioned on euro dollar. And I guarantee you now that the vast majority of retail traders will be short euro dollar. And why are they short euro dollar? Because the euro is going up. So again, it's human nature trying to pick the other side, the other side of that trade. So let's have a quick look. What's the percentage short? So, it's eased off a bit, 66% a short euro dollar. So okay, so short, but look at the trend. Again, I think we've been saying it for a while now. This is a market that continues to be strong. Clearly, at some point, this trend is going to run out of steam. But at the moment, it was only just over a week ago we saw this 2.5-year high for euro dollar. The market sells off for a couple of days, and once again it pushes up. So let's have a look at the bigger picture. here we go. We've cleared the hurdles of the old highs from 2016, and actually, yeah, of course, 2015. Well, not all of 2015, maybe, but for the majority of 2015. So it's a big break in euro dollar. So it does suggest, you know, I don't know, it was almost finger in the air, but I mean, I suppose 125, 126 doesn't look ridiculous. In the short term, yes, it's overextended, you know, so it is due, you know, something of a correction, you know, but that trend is still pretty strong. So for me, you know, even, you know, it needs to break below 116 to suggest that this latest run from April of this year is in any trouble. So I'd be a buyer on any level back to 116, you know, and if we saw it maybe down about 117 again, where it was middle of August, it looks like another good buying opportunity. Stop loss under that recent low, you know, but euro dollar still obviously strong. Pound against the dollar, of course, is a market that's you know, very much driven by the old Brexit doodah, shenanigans, never out the news, negotiations. You know, that seems to be one of the main facts driving the pound. But like euro dollar, nothing much has changed. You know, since last week. I think, you know, we've got this bigger picture trend in place, recovery, I should say, in place. Oh, I've not drawn that very well. But off these lows, so I drew it off the lows from the beginning of the year. Then it looks something like that. So it's lost that more aggressive trend there. But you know, support at 128, which it did push through. So there's an example there. If you'd have bought into that weakness there, you may well have been stopped out. You know, so even if you set stops in inverted commas, you know, the correct place, you can still get stopped out now and again. You know, it's not perfect, but I think you give yourself more of a chance. So the low was 128.12. And it traded as low as 127.74. So if I'd have been buying there, I'd have been stopped out there. But the market's bounced back. Obvious objective is a run back up to those early August highs at 132, 133. And if we can break there, then I think, you know, we're looking for the post-referendum sell-off highs, you know, up around about the 135 level. So I think for pound against the US dollar, it's still strong. You know, I think the bias is still for a bit more of a pound recovery, but still, of course, very much driven by all the euro, Brexit, doodah stuff. Okay, let's see. But euro sterling, we looked at this last time around, didn't we? I think to take the dollar out of the equation, this is an interesting one. Just as everyone's coming back off the holidays, we could see the euro weaken a bit. You know, it's had a heck of a run, really, after being, I think, maybe somewhat range bound following the referendum, the sharp move after the EU referendum last year. You know, we've seen that breakout above 90. But there are lots of hurdles, and the trend is still strong for euro sterling. The bias, I think, is still up, but there are, you know, 94, 95, the all-time high. Is it the all-time high? 98, where a euro was worth nearly a pound. So I think for euro sterling, even though it's still strong, it's maybe not as clear-cut an argument as the euro dollar one is, but I think that's always an interesting one to watch, euro sterling. Right, let's take a look at a couple more before we finish. So let's have a look at the price of oil. I have returned to my previous success on oil in that I can't seem to do anything right the last couple of weeks. So after having something of a purple patch trading oil in the last 2 weeks, I'll show you the two trades I did. There was one trade I was long, and I sat on it forever. Well, for maybe 2 weeks, and I just couldn't. Hang on, the market just wouldn't move, and I got stopped out. I think it was where was it? It was probably here actually, where the market had been tailing off, broke higher, pulled back. So perfect little setup. So I bought maybe in here or maybe in here. I can't remember. And then put a stop loss below that low, below that big low there, thinking, okay, maybe the market's going to march all the way back up to 50. So the market faffed about. I was in profit for a bit, then it sold off. So I got stopped out. So then the next day I thought, well, clearly we're in a downtrend now. So the market rallied up. I went short, maybe here somewhere. So market fell off a bit, but not enough to move my stop. My stop was there. And then at the end of last week, the market rallies and takes my stop out. So I've been long here stopped, short here stopped, and the market's up where it is. So yeah, a bit not quite as clear cut for me, oil, I think the last couple of weeks. And again, it's this sort of move, isn't it? It's where you get caught maybe in a trend change. And I think this is clearly what was going on with me. I'd done quite well on the way up, June and July, but got chopped about a bit, getting wrong-footed by the trend. So where does that leave us? I think it's interesting because it looks, you could argue, I suppose the trend looks maybe something like that-ish. So you could argue that the trend, actually, if I'd taken it from there, it would have been better. The trend for most of this year in the price of oil is down. We've gone from $55, $56 a barrel to trade as low as 42. That trend is still intact. So for me, there might still be a little bit left in the tank to sort of push up to maybe the July highs at sort of 50, 51, but then we'd expect it to run out of steam. I think if it starts to break 51, it's a whole sort of new start of a new trend, maybe for the price of oil. So I think it's an interesting one. I don't have any trades on the moment. I think I'm going to stay away from it for the rest of this week and see what happens. But I think this whole 50-51 area for oil, if it gets back up to here and starts to push through, I think we can start looking again at sort of 56 plus, because I think the beginning of this year, the same way I thought it could be a year for a gold recovery, I thought we'd see much more for oil. I thought we'd see mid-60s for oil, given the recovery that we saw for much of last year in the end. So I think it's an interesting one to see what happens, but 50-51 area on oil. So I'd say if I had to do a trade at the moment, I'd be tempted to be a seller with stops above these old highs from beginning of August. But I think that's maybe one to watch. So I think FX is maybe a little bit boring. I think, relatively speaking, I think in the short term, I think this afternoon and tomorrow is going to be for me US stock markets, just because of the old Mr. Trump and North Korea stuff. How are we going to see US stock markets react? So there's the Dow. Let's just plonk that trend line on the Dow and see what that looks like. So if we go from there, it's still above it. The Dow is still above it. So again, the trade for me, if we were going back to this whole stop loss thing, if you thought, well, that the Dow peaked August the 8th at 22,200 near enough, and has sold off since then, and has sold off a bit and has bounced back overnight. For me, the trade on the Dow, if you believe the market's going back up, we're a buyer now at 21,797 with a stop loss underneath those lows, and those lows are 21,600. So we've got a couple 100-point stop loss and a bit more. But if we're expecting the market, to ramp up 500, 600, 700 points, that shouldn't really be an issue. So that's clearly, I think, one area to watch on the Dow. Those lows, 21,600 lows. So we are 200 points above that. But as we know, if the market really starts moving, 200 points can be not that much. But I'd say that the Dow, it still looks bullish. Let's not forget both of these US stock markets indices, the Dow and the S&P. It was only last month they set fresh all-time highs. But I think there's some obvious levels to watch. If you see these levels start to break, I think it will put a bit of fear in investors. So let's see what happens. But I think stock markets are the ones to watch. And tomorrow, 12:45 tomorrow, European Central Bank, of course, it's the European Central Bank's interest rate decision. No change expected, but they may say something about the amount of stimulus that they've been giving to the European economy. So as usual, we can see something of volatility, for stock markets and the currency off the back of that. And that's it, I think, for this week. Let's see what happens. I think it does feel like things are getting back to normal after the summer. If you have any questions, you can drop me an email, david@tradeafter.com. I've been blogging about using a follower account to follow other traders, and you can see the progress of that on tradeafter.com. That's with Aondo. But for this week, we will wrap things up. Thanks for coming along as ever, and we'll do it all again same time next week, 12:30 next Wednesday. Okay.